Imagine a country that's been growing at 10% per year for 30 years nonstop. And then, suddenly, it finds itself stuck at 3, maybe 4%, with a collapsing housing market and both old and young people out of work. And everyone pretends this is a normal slowdown, even though the numbers, they look more like the beginning of a controlled crash landing. In this video, I want to explore why China has roughly 24 months left to either rewrite its economic model or hit a wall. Not necessarily with a huge bang, but definitely with a broken suspension. And yes, this isn't clickbait. The IMF is already projecting China's growth trajectory to 3, maybe 3.5% by 2028. And that's the optimistic scenario, without a complete crisis of confidence in its banks and bonds. Let's start with the fact that China is still selling the world on the image of almost 5% annual growth, although independent estimates point to 2.5%, 3% at best. Look at the details: nominal GDP, inflation, weak demand for credit. All these indicators reveal an economy that's not accelerating, but struggling just to stay afloat. The IMF says it outright. By 2028, growth will drop to 3.4, 3.5% due to an aging population, declining productivity, and a housing crisis. Beijing, naturally, responds, "No, you're wrong. Everything is under control." But when a country reports a near-perfect GDP trajectory year after year while the housing market is collapsing, it becomes difficult to trust the statistics.
Now, the main patient is Chinese real estate. It's not just an economic sector, it's practically a religion. Apartments there, they've been a pension fund, a cryptocurrency, and a lottery ticket, all rolled into one. In recent years, the largest developers, Evergrande, Country Garden and Company, they've simply stopped paying their debts. They're accumulating trillions of yuan in liabilities to banks and equity holders. Evergrande has a capital hole of tens of billions of dollars. Country Garden? Hundreds of billions in liabilities and thousands of unfinished projects all across the country. The government is trying to ensure a soft landing. They're allowing debt restructuring, recapitalizing banks, forcing local authorities to buy up illiquid assets through their funds. But the economic math is simple. If housing represents 20 to 30% of GDP and prices there are stagnant or falling and sales are stagnating, growth in the old format will never return. The next layer? The local governments. They built this entire concrete civilization with borrowed money. The total volume of their debt and quasi-debt through special funds is estimated at approximately 70 to 90% of GDP. We're talking tens of trillions of yuan. The model looked good on paper. A local official takes out a loan, sells land to a developer, builds roads, subways, and stadiums. He shows growth and gets a raise. The problem is, now the developer has gone bankrupt. Land prices have fallen, and the debt remains with the municipality, and they can't recoup it, not with taxes, and definitely not with new sales. To prevent a chain reaction, the center has essentially authorized the spreading of problems over time. Extensions, payment freezes, hidden subsidies. On the surface, this looks like stability, but in reality, you're simply moving the landmine from 2024 to 2026, with interest accruing every single day. Now, demographics, the most boring and at the same time, the most devastating factor. China has been losing population for several years now. The proportion of elderly people is rapidly growing, and it's a classic pattern: fewer workers, more retirees, and a much higher burden on the budget. The peak of the working-age population there was already reached before the pandemic, and this is evident from the same IMF procasts. Growth potential is falling from 10% in the 2000s to 3% in the 2030s. Fewer young people means less domestic demand for housing, fewer startups, less innovation,
and more spending on healthcare and social benefits. China's export-led growth model has always been tied to cheap, mass-market labor. When workers become more expensive and disappear, and robots and automation haven't yet compensated for all the problems, the profitability of those old industries, it just dwindles.
Now, imagine you're a young Chinese man, fresh out of university, and there are practically no vacancies in your field. Official youth unemployment data simply stopped being published at some point because the figures were becoming politically toxic. Meanwhile, young people see the real estate market collapsing, the state squeezing IT giants and private businesses, and they draw a simple conclusion. The system is playing with us, not for us. In response, people begin to minimize consumption, hoard cash, avoid taking out loans, avoid getting married, avoid having children, all the things that make any economy look old and sluggish. From a demand perspective, this is death by installments. Loans aren't growing, retail sales are stagnating, and money is stuck in the banking system rather than in the real economy. This kind of public behavior is ideal if you're preparing for a storm, but terrible if you are counting on a consumer China model to replace the export-led economy. Okay, maybe China will simply return to its good old model, producing everything for the world, winning on scale and price. The problem is that the outside world no longer plays by the old rules: tariffs, sanctions, restricted access to chips and technology. Research shows that a new wave of U.S. tariffs on Chinese imports, which the Trump administration is already discussing as Trump 2.0, could wipe out up to 12 to 15% of Chinese exports and cut off almost a percentage of GDP. For a country already struggling to maintain 4 to 5% growth, this is a blow from which you can't recoup in the old style, unless you have a new engine. And there is no new engine. Some production is moving to Vietnam, Mexico, and Indonesia. Even Chinese companies are relocating production facilities to circumvent the tariffs, which means that once you lose exports, it's almost impossible to regain them. Here, many economists shrug their shoulders. Well, yes, things are bad, but it's just a repeat of Japan in the 1990s. Bubble, deflation, 20 years of stagnation, no explosions. On paper, the comparison is attractive. Aging, real estate, banks with bad assets. But there are two differences. First, Japan entered its stagnation already wealthy, with high incomes and a social system that could be financed for decades. Second, Japanese debt was primarily circulating domestically in the hands of domestic investors rather than as a complex tangle of LGFVs, offshore developer bonds, and shadow banking. China is poorer per capita, more reliant on real estate, and its banking system is less transparent. Therefore, the baseline scenario, yes, is more like secular stagnation, but the risk of a real financial event with banking problems and panic is much higher.
Now, the main question, okay, why 24 months and not 10 years? The answer lies in the combination of three timers. First, real estate. We can't drag out the restructuring indefinitely. In the next couple of years, developers must either officially write off the majority of their debts or continue selling air, which is already practically unworkable. Second, local authorities. According to many estimates, they are currently squeezing out the last refinancing opportunities through banks and semi-state funds. But in 2026-2027, repayments on old issues will begin to peak. Third, the outside world. The tariff war and technological decoupling accelerate, and the relocation of production is irreversible. A factory that went to Mexico will not return to Guangdong. When these three things coincide, roughly around 2026 to 2028, an economy accustomed to credit growth may simply hit a ceiling. New loans aren't working, old ones can't be repaid, exports can't support them, and the population is saving. It's important to understand, An economic collapse doesn't necessarily mean images of burning banks and people running through the streets. A much more likely scenario is something similar to your own life if you live in a country with a protracted crisis. What does this mean in practice? A slow decline in real estate prices when your apartment turns from an asset into an anchor. A decline in real wages when inflation is low, but bonuses will no longer be available. Saving on everything, education, leisure, health, because you don't believe in tomorrow. Rising taxes and hidden fees when the state needs to plug holes in regional budgets. The system, of course, benefits from pretending that everything is going according to the modernization plan. But for the average person, this will look like a slow loss of options. Fewer job openings, fewer career advancements, more controls and demands to tighten belts for the sake of abstract stability. To avoid a severe blow, China needs to do in a couple of years what takes others decades. Rewrite its growth model from concrete and exports to domestic consumption. Honestly acknowledge and write off the bad debts of developers and local authorities. Open the market to private business and foreign investors without political repression. Create a social system that allows people to save less for a rainy day and spend more. Some of this is already declared on paper, but the reality is different. Increased control, campaigns against excessive consumption and incorrect values, prioritizing security over growth. Politically, acknowledging the scale of the problems is difficult. Who wants to tell the public that their savings have been in a bubble for 20 years and now need to be deflated? Strip away all the noise and the picture is simple. China enters 2026 with an overburdened real estate market, a mountain of hidden regional debt, rapidly aging, and a world no longer willing to finance its old growth model. The IMF and leading analysts are diplomatically talking about a slowdown to 3.5% by 2028. I would translate this into layman's terms. The system has a few years to perform this painful surgery. Otherwise, the crisis will do it itself, and without anesthesia. So, the next time the news reports that Chinese GDP has grown again by almost 5%, keep this simple thought in mind. The real story is not in the reports, but in empty new buildings, overburdened local government balance sheets, and the decisions of millions of people not to take on unnecessary debt. And it is there that we can see why this growth looks less like the beginning of a new era and more like the last months before someone finally turns off the lights.